Welcome to the daily update, where I'll go over the action in the market from Monday, July 22nd, and then we'll see how things look for Tuesday, July 23rd. Had a bit of a bounce. Now we have to decide, are things switching back and looking more positive, or are we just seeing a little bit of a bounce before we get set to go lower? You can make a case for either side at this point. But because we were able to reclaim the 20-period moving average, that switched our short-term trend back to positive, but we still are seeing some weakness under the surface. We're also seeing some improvements. So we'll go through that and see how things are shaping up. I do have a thing called the SPXInvesting Program. If you want to have early access to these videos, which is the real foundation of the analysis and commentary that I do, you have to get that by going to the website. And there's a link in the description below this video. There's also another link to tell you more about the program, a series of videos that I've done. It's a playlist on YouTube. There's also an email address if you want to contact me. And this is how I set up the videos, where the daily video is the hub of everything, and all the other videos that I do are kind of on the outside. So let's go back and talk about what happened, and then we'll look at some charts. We had a gap higher open. The futures were pretty strong and kept getting stronger as we got closer to the open. We opened above R1 at 55.43, and then we hit resistance. We bumped up there 3 times before we were finally able to go above it. We hit Friday's daily pivot at 55.60, which again is another round number. But then we declined and then ended up finding support at 55.30. As the day went on, prices were finally able to climb above 55.60, and we closed near the intraday high. So that in and of itself is kind of positive. Didn't see an awful lot of conviction behind the buying, and we were below average with volume taken all together, but still, it was a recovery bounce. We're wondering now, are we going to shift back and look more positive? So we were up 1.08% on below average volume, not much below average, but still it did drop off. And we are now back to positive in the short, intermediate, and long term, but lots of warning signs right now. We're going to get GDP, the advanced reading. That has an inflation component. That'll come out later in the week. And we're going to get core PCE on Friday. The markets may be anticipating that. They may try to front run those things a little bit. And then all the geopolitical concerns in the world and those crazy things going on in the US right now. Some comments, mega caps and semis, they bounced after last week was a down week for them. So we saw some buying coming in that way. And if the S&P and the NASDAQ 100 are going to really be able to bounce from here, we're going to need to see more follow through from the mega caps and semiconductors. The parabolic SAR, it's still negative though. This is the 3rd day now that this has been negative. I treat this as a primary indicator, and that's still a warning sign. The markets are not really reacting much to what happened over the weekend with the political news that I'm sure you all heard about. I don't need to repeat that here. On a short-term basis, the ADX is still extreme. It's above 40 on the short-term chart, but we're crossing over. We're seeing the red line just barely starting to cross below the green line. So that is turning negative. In the intermediate term, the ADX is also weakening, but still above 40. And the green line turned up just a little bit there. So we haven't quite crossed over negative. And then we have a chart that was on here for a long time, and then it's been off. Now it's back on. This is a 10-day moving average of the highs, new highs minus the new lows for the S&P. And that's more of a longer term momentum type of indicator, the way I interpret it anyway. And that's getting up to an extreme positive reading, which is positive in and of itself. It just means there is good momentum. And even as we were going up with the mega caps and the semis really helping things to go higher, this indicator was not improving. Well, now it is. So that is more on the positive side. Then on a long-term basis, we have we're getting kind of extreme with the 200-period moving average, and then the rate of change going back 200 periods is looking extreme again. The scenario hasn't changed as of right now. The market is pretty much figuring in that the Fed will cut rates in September, and I went through the probabilities of that in the weekly video over the weekend. The dollar was down. That gave some support to stocks, but interest rates were up. We closed at 4.26%, where we had been at 4.24%. We're still inverted with the yield curves, and we're getting a little more positive as far as sentiment. We closed in positive territory now at 56, where we had been neutral at 49. We're still looking, I guess, okay with the trend for right now, but the ADX is weakening and it's below its moving average. So it's a weakening trend, but we're still above 20. And then with the update, the bias is positive, and the last number of days, I'm putting it as mixed right now. So we didn't have any economic reports, so there's no charts to show you. Looking at this, and I know this is blurry on the bottom, I have to expand my browser screen by up to like 500% just to get this quality of picture on the bottom. But this just says, and it's more positive in nature, another clue, any weakness is a buying opportunity. Okay, well, if you look at when we've seen components that are hitting a 20-day high going back to 1972, and then you can see looking forward that, okay, 1 month, 3 month, you've got about a 50-50 shot there. But further out, 6 months and 12 months, the possibility of things being higher increases. And then we look at the S&P 500 and then the earnings per share. This is put out by Goldman Sachs, and it's their forecast. And this also justifies stocks going up because they're looking at earnings forecasts going up as well. And then U.S. small cap flows dwarfed by flows in U.S. large cap funds. That's been all the rage right now. Our small caps finally getting ready to take off. That's the light blue line here at the bottom. Well, if you compare it to the money going into large caps, that's why they say it dwarfs here, because we're still seeing a lot more money going into the large caps. And then investment grade bonds, they're seeing a lot of inflows right now. These are the more conservative bonds. These aren't junk bonds. These are like corporate bonds that are for companies that have been around. These are government bonds that are considered to be very safe. We're seeing money going back into those. And then the number of trading days in a row without a 2% down day since 1928, we're getting up here, but not necessarily out of the norm when you look at this in comparison to what happened other times. Then managed money in the gold futures, a lot of folks are still getting into gold, even though, as I showed over the weekend, gold is not necessarily outperforming stocks. It's been chopping sideways, and on a ratio basis, the S&P and gold are sometimes gold looks a little bit better, sometimes the S&P looks a little bit better. Couple of charts here. This is looking at another way of judging seasonality, the median historical performance over the next week. And this was based on where we're at right now. 1 week out, 0.29%, and we're up 51% of the time. I guess that's what they're trying to say here. And then 1 month out, we're up 0.43%, 30% of the time. 3 months out, we're down 1.38%. And that's the worst performing time longer out. So we've got some contradicting information here where the Carson chart said, everything's looking okay out into the future. This chart suggests that maybe it is not. And then this was put out by Jim Bianco. I follow him on Twitter. He's a guest on some of the podcasts that I listen to from time to time. And then he made an appearance on Bloomberg. And this is kind of a follow-up to that. It just says, Jim Bianco of Bianco Research says there is no Trump trade. Just look at the charts. I mean, we're not really seeing any kind of a massive change here. He says none of the recent political events have impacted the markets and not much will change after the presidential election. And folks that want to either blame the president when the market goes down or thank the president when the market goes up, that's just not how it works. And you may feel better about life depending on what's happening and if you agree or disagree, and so you feel worse about things. That's one thing. But for how the markets actually behave, it really is not all that dependent on the president. The markets are more focused on regulation and any laws that are passed. In fact, they like it when there's a split Congress between Republican and Democrat, because that means there's less of a chance of things actually getting done. Markets tend to adjust to the status quo, what's already out there. It's something known. It's something that they can deal with. and they have friends on both sides. So it tends to really not be political. And that's why I don't really focus on politics in these videos. It's irrelevant. And some people like to put that into the whole mix. It can have an impact, but it's usually some kind of an event that catches the market off guard, something either good or bad. But for the most part, the markets just kind of do their own thing and treat what happens in Washington, D.C. as political theater. Okay, and then I posted this before, but it's been a few months. Every once in a while, I run across this headline. This was put out in December of 2000, and it said the internet may be just a passing fad as millions give up on it. Well, no, I was teaching a lot of internet classes at that time, and a lot of the technology behind the internet. And no, the classes were full. So I don't really know where this came from. And it's just kind of interesting when there's something new, because I've been online since 1989, which was also the birth of HTML, which is where we get our web browsers. It's the language that you use to be able to read web pages. Now they've expanded beyond that, but it's just been growing. Somebody just decided to come up with something here that obviously turned out not to be true. Then Edward Yardeni, this wasn't on Twitter. This is from his email, and he likes how things are looking right now from an earnings perspective. And this is a chart going back where the blue line, this is the capitalization share. This was going into the dot-com boom and then bust. Well, you can see, and a lot of folks are trying to point this out. Look at right now, it's just like the year 2000. Well, no, it's not. There's some similarities for sure. Okay. And that's why people are talking about it. But those companies had no earnings. Those companies were built on dreams and unrealistic expectations. I mean, you'd have a company going public at the time and they were blowing corks off their champagne bottles with a bunch of boxes around because they're standing in a warehouse. They haven't even moved into a building yet, and they have made no sales, let alone any earnings. That's what was happening back at the dot-com boom and bust. You have companies now that are actually generating earnings, and those earnings are growing and they're more established and they've stood more the test of time. So Edward Yardeni says here in his email, the bears warn that stretched equity valuations will prevent the party from going on much longer. And of course, the bears, they're always looking for the world to end and the stock market to crash. We have acknowledged that the current stock market is reminiscent of the value-led melt-up of the 90s. And that's true. You can look at the chart and just see that. And that's why people are trying to pick out some similarities between the two. Then he says, but we've also noted that the current bull market has more support from earnings. For example, while the combined market cap of the S&P 500 IT and communication services, they're 41% of the S&P, which is pretty much, if you look at the blue line here, it's pretty close to what it was back in 2000. And the bears are pointing this out and going, look, we're coming up here, man. This is going to be a crash. Well, read a little bit further. The two sectors currently represent a third of the S&P 500's forward earnings, where in 2000 they represented no earnings. Look at where the red line is down here. So there's a really big gap here where, yeah, there's a gap here, but it's going up and the gap is much smaller. So anyway, all right, let's look at the intraday chart here, where we saw most of the gains really right at the open. The futures were positive. We opened up above R1, and this was the daily pivot from Friday. And I even made a post on the website about this. We bumped up here a number of times and just could not get above that level, but we didn't drop down here. We ended up finding a support level, and then we just kind of drifted higher. We finally, without much ceremony, were able to get above the daily pivot from Friday, but there was really no pickup in volume. There was really no pickup in price movement, and we drifted a little bit going into the close. So yeah, it was an up day, but not an awful lot of strength or conviction really went into the move, at least while the market was open. And then here, this just shows when Europe had a really good day, and that's when the futures really started to turn and look more positive. And we can see the initial choppiness here, and we were up on the day. We're actually down just a little bit in the initial overnight session. And growth and value are just kind of duking it out back and forth to see which one's in the lead. They both were up in Monday's session on the intraday chart. Saw a little bit of an improvement with S&P growth to value on the intraday chart. On the end of day, we were up quite a bit more, but they had a bit of making up to do here with growth versus value, and everything was up. Growth was up more with the mid caps as well as the small caps, but not seeing an improvement that much here with the end of day charts with the small cap growth to value or the mid cap growth to value, or even with the S&P growth to value. Not really seeing much of a turn up here when we look at the growth versus value ETF. And discretionary to staples, a little bit of a tick up, but not a real big improvement. Although there is an improvement, and you can take that as being positive. Large cap growth was up 1.35%, a bounce after it had a pretty rough week last week. The ratio between large caps and small caps, it's still declining here as we're seeing this rotation that is taking place where folks are getting more into the smaller stocks right now, thinking that interest rates are going to come down because a lot of these companies are leveraged to the hilt. And if interest rates go down, that really helps the small caps. The Wilshire did have a nice little bounce up over 1%, but still off of the all-time high. This is where we're seeing a little bit more concern here. The ADX is still going below the moving average. That's a weakening trend, but we're still extreme because we're above 40. Now that's a static number that I use just to kind of give a benchmark of where we're at. The green line is declining, but it hasn't crossed below the red line yet because the red line actually declined. We're looking a little more negative here. We're also seeing a weakening trend with our short-term ADX, but the green line is now starting to drop below the red line. We did drop off with volume, but it has been above average over the last number of days. We will probably see a drop off in volume as July and August play out for the NYSE and the NASDAQ. Then sentiment, here's the weekly chart. Now over here, they have us being in extreme greed territory of a reading of 87.83. Okay, that's a little bit different than what we're saying, but this is more of a composite where it takes a lot of different sentiment gauges and puts them together. Also, the latest legal insider transaction ratio is coming down. We're more neutral right now. So not really seeing all that much of a change here with the insider buying ETF. In fact, it was up on Monday, but it did go down last week. The Ulcer Index is picking up a little bit of steam here, showing that there's an increase in fear. We came down with the VIX on a closing basis, but we're still seeing higher levels than what we've seen in a while. We also declined with the bar chart. And the VIX of the VIX came down because we had an up day. So we're seeing that, but still these are higher readings than what we've seen. The momentum of the VIX still continues to be up. And this is updated now. This is the seasonality of the VIX, where it's starting to pick up. And if we stick the seasonal form, we could see the VIX go up, which means stocks are going down. A skew index, not giving us an extreme reading now, but we've been chopping around right into this red area and then a little bit below, then a little bit above, then a little bit below. So, but we're not extreme at this time, but we are still extreme here with the VIX to S&P 500 correlation. We're still above this dashed line, and that is typically negative. The equity put call ratio did decline on the daily chart. We're starting to turn back up on the 5-day. Here's a longer term look at the 5-day after getting to an extreme reading. We could have gone a lot lower than this, and we still may turn around and come back down and be lower, but for right now, it's still going up. And the 10 period is also continuing to go up, and that's tending to be more negative for the market. The volatility risk premium did decline, but we're still above this band, showing that the VRP for right now is quite high. We were pretty much flat with this one fear gauge, and we declined a little bit here with this other fear gauge with the up day. Not seeing an awful lot of change here outside of the range. We were up 1% with the risk on to risk off ratio, but we've been just bouncing around in 2024. Saw a little bit of an improvement here with the advanced decline line based on price and volume, but still below these recent highs. And we saw a real drop off in the new highs here. We're still going up with our 5-week moving average. We're starting to decline with the 10-week. So we're seeing a bit of mixed signals here with our internal measures inside of the S&P. We were up slightly, and we're still looking positive with the advanced decline ratio, both with the 19 and the 39 period. That's short and intermediate term. We're turning back and looking a little more positive here with accumulation distribution. We saw enough of an upturn here to get slightly above the moving average with the boom indicator, but we're still below this shorter term moving average that I use to kind of give us some context as to what's the direction actually doing. And we're looking just barely positive again with the Chaikin money flow after we were negative for a couple of days. But the Chaikin oscillator ticked up, but is still negative. So our smart money indicators looking a little bit better, but also showing some negative signs. And this is kind of interesting. We're seeing the cumulative advanced decline line for the NYSE. It is going up, and that's still showing more broad market strength. We did go up here with the regular NYSE advanced decline line, and we also ticked back up, and we're well above the moving average. So in the broader sense, things are still looking more positive. And we ticked back up with the common stock based on price. We ticked up just a little bit based on volume on the NYSE. And we ticked up with the cumulative S&P 500 based on price and a little bit better based on volume. The advanced decline line measured against the S&P 500. They're both kind of moving in tandem right now. And we saw a little bit of an improvement, and we still have been holding up with our advanced decline line studies with the NYSE common stock, the S&P, the mid caps, and the small caps. Not really a big change here with our daily chart. We're kind of in between right now, and it's a little hard to see this because of these pivot points. On the bottom, we were slightly below the moving average with volume. Rate of change, maybe overdid it just a little bit. We got up above this blue line. We could go a lot higher than this, but sometimes this just may suggest some short-term exhaustion. Not necessarily a reverse, but maybe a slowdown. And then looking at our double and triple exponential moving average based on 20 periods, we're still below the lines and the lines are declining. So that's still jeopardizing the short-term trend. We did tick back up with the 20, 50, and we're flattening out here with the 200-day moving average of those moving averages on the S&P itself. But we were able to reclaim the simple and exponential 20-period moving average. So even though we're showing some weakness on those previous 20-period studies charts, we are looking a little bit better here in the short term. And that's why I've said we've switched back to positive with the short-term trend, at least based on this. And we're getting a little bit above the midpoint with our standard deviations chart, so that's improving slightly. We turn back up and we're still positive with the balance of power, still more neutral to even a little bit negative with the go, no go, since it has the lighter shade of blue bars. Getting a little bit back above the midpoint with our highest high, lowest low value charts. TTM squeeze, though, continues to decline with the darker shade of blue. Here's the 50-period double and triple exponential moving average study, showing some improvement here. This is holding up a bit better. The red line, which moves faster, is still above the blue line. So even though we're below it, the lines haven't rolled over at least yet. And we are keeping an eye on the 50-period moving averages now, just in case we fall down to that level. The ease of movement did tick up, and it's still positive above zero here. The Erin is kind of going flat to declining slightly. And we're still positive with the S&P McClellan oscillator. We're above zero. We had really come down in Friday's session. We ticked back up on Monday. So we're continuing to go up with the summation index based on price. But look at how the summation index based on volume continues to decline. And sometimes this is a leading indicator for us. The NYSE McClellan oscillator also really declined on Friday, ticked back up on Monday. We're still going up with the summation index based on price and volume for the NYSE. We're still declining here with the Swenlin trading oscillator based on price and volume, even though both are still above zero. We're starting to turn more negative on a momentum basis with the PMO now crossing below its moving average and coming down below this red line. But when you break it out based on price and volume, even though we're rolling over here, we are still positive. So saw a little bit of an improvement with the PMOs that are rising, getting flat here with the buy signals and still going up with the PMOs that are above zero. And we've gone from 2 negative days here with the Elder's Impulse system back to a neutral reading for the S&P. But the parabolic SAR is still negative with the dots on top. The slope oscillator starting to decline and coming back down to this green line, which I mark as an extreme positive reading. We're declining with a little bit more velocity here with the MACD. So we're starting to turn more negative on a momentum basis in the short intermediate, and even the long term is now starting to roll over. And we were able to recapture the 20-period moving average. And so all of the lines underneath it, the longer term moving averages, those are still positive. The bullish percent index, this is still encouraging. It still continues to hold up. And we're looking pretty good with the NYSE bullish percent index, even though it ticked down a little bit. But the NASDAQ 100 bullish percent index actually declined and is below 50, so that has turned negative. The money flow is above 50 and advancing. That's positive. Or the ultimate oscillator, it's still below 50, so that's negative, but it did turn back up. And we're looking a little better here with the vortex, with the green line trying to turn back up, and the red line is declining. And we're bouncing off of the 50 level with the RSI 14. When we're really doing well with the S&P, we see most of the readings above 50 with the RSI 14. We fell below 50 here with the shorter term RSI, but now we've been able to climb back above that. And standard deviation still just a little bit above its moving average as the market's been gyrating a bit lately. Unbalanced volume continues to be positive. Still looking pretty good here with our 20-period moving average study of those stocks inside of the S&P. And our study is looking better. We're still above the 70 level and looking a little better with those stocks above their 50-period moving average, as well as a tick up with the 100 and the 200. But we're still negative with the Copic curve, which is another momentum oscillator. We ticked back up, but not extreme with the Sean trend meter. This is still looking better on a bigger scale across the broad market. This is the 5-period moving average of the highs minus the lows. It's off of its highs, and it came down a little bit, but this has been holding up. Then we are still looking good on a longer term basis. We closed last week above this R2 level, and so far this week we remain above that R2 level longer term. And we're getting back up into the high end of the rainbow here with the mini rainbow when we look at the 20-period simple moving average of the open, high, low, and close. And we're coming back up above this 50% extension level for the S&P 500. And we're seeing kind of a mixed picture here, looking a little more negative with the Heiken Ashi, still looking positive with the Kegi, looking negative with the Renko, and looking a little more negative with the 3-line break. Long term, though, we're starting just barely below this extreme reading with the 150, but we are still extreme positive with the 200. That could also suggest longer term positive momentum. This is the chart I was talking about earlier. The 10-day average of the S&P 500 highs minus the lows. Even when we were going up, it's not like this chart was falling apart, but it wasn't really giving us strong readings like we were getting earlier in 2024. We were just pegged up here for months. We're finally starting to see a really solid move back above this green line, which means that more stocks in the S&P 500 are really looking stronger. Here's the 200-day rate of change, getting back above that blue line after it had fallen below on Friday. And we're positive, according to the Keller market model, on all time frames across all the different indexes. We're still negative with the price of bonds in the short and long term. We're negative with commodities in the short and intermediate term, as well as with the dollar index. No changes that I could see, even though they probably should switch this over on the PMO, but they haven't changed it yet. And we saw a lot of positive things, right, to start off with the NASDAQ, and then a few negative things. Discretionary, which is an area we'd like to see do better, but it's crossing below 70, which is a fairly high reading. The volatility index, the VIX, hit a 4-year low. That's kind of interesting. And then the NASDAQ actually ended up dropping below 17.8. So we only had one sector that was down in Monday session, and that was energy, with tech and discretionary doing the best. Still looking good here with the new highs minus the new lows on the NYSE. We're getting a positive reading just when we take the daily score. And we're still seeing a pretty good match here between the S&P 500 weighted index and the equal weight index. So our ratio didn't really change all that much. A little bit of improvement with the mega cap, so it ticked back up slightly. And the Dow is still above this R2 level. It was up 0.33% in an uptrend, just coming off of a recent all-time high. The diamonds still continue to be neutral when looking at the Elder's Impulse system. The NASDAQ is trying to bounce back up. It's still positive, though. It's still above its 50-day moving average. We're in a longer-term uptrend. We're wondering if we're going to come down to one of these pivot points here, which is just about where the 50-day moving average is located. Also saw a bit of a bounce here with the NASDAQ 100, also seeing the pivot and the 50-day lining up with each other. The Qs have gone to being neutral after being negative, but the momentum for the NASDAQ 100 continues to be negative, and we've turned a little bit here, but we're still in between this 23.6 and this 38.2 fib extension level. And the Qs are right in between their 20-period moving average and their 50. It was the first to give that up. We'll see if it's the first to get it back if we see more strength. The small caps were up 1.5%. So folks are still hoping that maybe something will happen there, but they still remain neutral with the Elder's Impulse system when looking at the small caps. We're turning back up when we look at the Russell 2000 small cap ETF with the RSI. That's starting to go back up, looking pretty positive here after seeing some profit taking well above the 50-day moving average, and the momentum continues to be positive. The mid caps were also up 1.24%, still above this R1 level, but still below this R2 level. And they still remain neutral with the Elder's Impulse system. And we saw a little bit more than a percent advance with the total US stock ETF, but still off of its all-time high. Apple was down slightly. Tesla was up over 5%. And we are likely, unless we see a big crash with Tesla here, we're likely to see a cross here. That would be a golden cross, changing the trend over to positive again. NVIDIA was up 4.76%. This is where some of the strength in the S&P came from and is climbing back above its 50-day moving average. Microsoft was up 1.33%, got above its 50-day moving average. Meta was up 2.23%, but still under its 50-day moving average. Amazon was down 0.33%, below its 50-day moving average. Google was up 2.26% and still bouncing off its 50-day moving average. Netflix was up 2.25% and also looking pretty solid, but not back to these previous all-time highs. The FANG index did bounce up over 2%, but it's been a few days since it set an all-time high. And we're seeing a little bit of a tick down here with the staples to tech ratio. That's what we want to see if we're more positive on the market. We want this ratio to decline. The dollar ended up being up, and it's also in a longer-term uptrend. And not really much of a change here with the short-term correlation between the S&P and the world index. We're still seeing it trailing off when we look at the longer-term correlation, just meaning if you watched any of the weekend videos, the U.S. stocks are still really outperforming the rest of the world. Keeping an eye on the 10-year yield, it was up, and the 10-year based on price was down, but this is encouraging. The home construction to 3 to 7 year bond ratio. This continues to go up, and we're starting to see the lines turn and go back up. So that is positive. And then looking at our possible positive scenarios with our growth to value ratios, really not much of an improvement with the Qs to S&P. A bit of a decline with discretionary to S&P, but we're still above an advancing moving average now. We ticked up, but we're below a declining moving average when we compare large cap growth to large cap value. So not much of a real change here with the large caps, mid caps, or small caps. And looking okay here with the advanced decline ratio based on price as well as volume. And the S&P to utilities ratio did tick down. We want this to go up, and that usually gives more support to the S&P. And we ticked down just a little bit with the staples to S&P ratio, but overall we have been declining. We want to see this continue to decline to be more positive. Then we're keeping an eye on the Hindenburg Omen here. We have yet to get a confirmation signal for the S&P. We have until August 2nd for that to happen. Not seeing a signal here either with the NASDAQ as well. So what's our outlook for Tuesday? Earnings season. That's what is going to be the real talk of the stock market right now as we get into a lot of companies reporting. As far as looking at the technicals, we are still positive. The semiconductors and mega caps, they did bounce up a bit in Monday's session, but overall they've been under pressure. This still, for right now, looks like a pullback, but there are some warning signs. We're going to get existing home sales, and then we have to keep an eye on all the different geopolitical things going on. We'll get existing home sales on Tuesday. And then Thursday is when we're going to get the advanced reading, the first reading of GDP, and then we're going to get the core PCE on Friday. And here's what it's looking like for the week. Seasonally, we're neutral to positive, so really no edge there for July 23rd. And this is where we could see during an election year, at least a day or two of some weakness before we level out just a little bit, according to what historically has happened. And here's another chart that was posted over the weekend by Stock Traders Almanac, where this is what we've been doing. The dashed line here. Let's see, or is that the Russell? I'm trying to find. Okay. This is what the other indexes have been doing. The red dashed line is the Russell. So, but typically we see things more flat going into the end of July. Tuesday is kind of flip of the coin, whether it's positive or negative, where longer term we do tend to look more positive, especially as we might see some weakness in July, but then we could see some strength going into August. This is also a longer term look during the fourth year of a new president. And that whole situation is kind of weird right now. And during a presidential election tends to be more choppy than when it's not a presidential election. Still kind of far away, wondering if there's a reversion back to these other times, because the market was just getting way, way far away from historical norms. And we're past the first part of July now. We're getting into the second part. So what are our warning signs? We're still keeping an eye on the defensive sectors. The growth of value, discretionary to staples, not really helping the market right now. And this should have been changed. We've actually were able to get back above the 20-period moving averages. The Chaikin oscillator is still negative. The parabolic SAR is negative, and our oscillators are turning negative. The ultimate oscillator, the Copic curve, and we have the momentum for the NASDAQ 100 as well as the bullish percent index. Those are all negative. On the positive side, accumulation distribution, yeah, kinda. I'm just measuring that because the boom indicator went back above the midpoint. Or the Chaikin money flow, just you have to use a magnifying glass, but there is a green little bump there where it's turned back positive. And we're still positive, and this is more encouraging with the McClellan oscillators and the summation indexes from they're really diverging from the rest of the market right now. But we're also, when we look at the summation indexes for the S&P, we're seeing price going up and volume going down. So in the broader market, it's looking a little better. There's some warning signs that we're watching inside of the S&P itself. The bullish percent index, this is one of the more positive things right now. And the Swenlin trading oscillator is positive but declining. Both our 5 and 10 period, they're actually going back up. Our advanced decline lines are positive and still hanging in there for right now. The money flow, the vortex, and the bullish percent index for the NYSE, those continue to be positive. And the financial sector, I didn't show that chart today, but it pulled back, but it's still looking good. So our conclusion, we're positive. We're wondering, is this mega cap rebound that we saw? Because I'm still kind of counting it as weakness here. We saw a bit of a bounce and it helped the indexes, but we're wondering, was it enough to really change the overall climate? So for right now, it depends on how you want to take this. We're positive if you just look at it by the moving average. But if you look at that moving average study based on the 20 periods, we're still looking a little bit weak there. So I decided not to change it on this chart here. We are still positive. We are seeing some weakness in the intermediate term, though, but we're also seeing some improvement and some more broad market participation where we're still positive in the longer term. So thank you. I hope you have a really good day, and I will talk to you in the next video.